Okay, let's get on with it then. Welcome to the third session of the International Conference on Inclusive Insurance, the digital version, which is, I guess, a first for all of us, and may not be the last, I think, but it would be great to see everyone's face as well. But unfortunately, you're stuck with the three of us. My name's Nigel Bowman. I'll be facilitating the session today. I've got two really good speakers lined up to talk to us about pricing inclusive insurance in the midst of a pandemic. Obviously a very, very topical situation. First up will be Jeff Blacker, who's going to speak to us about pricing, obviously, and he's going to demonstrate an approach that will be used, or that can be used when there's very little or no data on which to make your pricing assumptions, which is an extremely, I think, relevant topic for us in inclusive insurance. Jeff's a qualified actuary with over 20 years of experience in the US, Latin America, Africa, and India. He has extensive experience with inclusive life and health products, and he's also published a collaborative book titled Actuaries in Microinsurance. Our second panelist is Denis, who I think probably doesn't need much introduction to a number of people on the call. I could probably describe him as one of the pioneers, if not the pioneer, of actuarial pioneer within inclusive insurance. And when I became involved in inclusive insurance, probably about 10 years ago, Denis seemed to have been around for a heck of a long time already and was speaking with quite an authoritative voice on all actuarial issues. So I don't think we could have anyone better qualified than Denis to speak about the impact of the major risk events, such as natural disasters and, of course, pandemics, and what the impact is on claims and on pricing. Maybe before then, just a few housekeeping rules. If we can maybe go to the next slide, please. So today's session is scheduled for 90 minutes, and that'll include the question and answers. All participants will be muted, but your questions can be submitted by a Q&A feature. Please use the Q&A feature, not the chat. We won't necessarily be monitoring the chat as well as the Q&A. The session is recorded and will be made available online, and you can submit any technical issues to the Microinsurance Network executive team via the chat function. Just please take care to submit it to the MIN executive team and not to everyone. Okay, yeah, so let's get started, and I'll hand over to Jeff to do his presentation.
Thank you, Nigel. Hello, everyone. I will share a screen here. Hopefully everyone sees my slides now. Nigel, nod yes. Do you see slides? Okay, great. Well, good morning or good afternoon. My topic will be pricing insurance without data. So it's a challenge finding relevant data in inclusive insurance, but there are solutions. The first three items on this agenda I'll go through pretty quickly: the basic concepts of pricing, sources of data, and focus groups and surveys. And then we'll talk about stochastic models. And then the fun part, I think it'll be fun on this presentation, we're going to do a Zoom poll of the audience, and we're going to plug the results of the Zoom poll into a stochastic model, which is an Excel spreadsheet in this case. And we will do a live pricing using a stochastic model based on your survey results. So let's start with the basic concepts. You know, there can be different types of products, and they're all a little different when you're priced. You can have non-life or general insurance, health insurance, and life insurance. And they've got differences and similarities. So the differences could involve different data, models, and different margins. And what we mean by margins here would be additional premium you charge to make sure that you have enough money to pay all the claims. And if your experience comes in favorable, then that margin contributes to your profit. So you have differences, but the process is the same regardless of what type of product you're pricing. So today I'll be focusing a lot on life and health. That's my background. But if you're mainly involved in crop insurance or something else in general insurance, the process is the same. So what does the process look like? We start in the top left with gathering data, but actually before you gather data, you need to have some idea of some outline of your product that you're pricing. So maybe you do some market research first, get a product in mind, then you start this loop of gathering data, setting assumptions, calculating, validating the results of your calculation, and if they're not what you need, then you repeat this loop. The output of this loop is your expected claims and the premiums you need to charge to be sure you can pay those claims and all of your other expenses. So the top of the slide says gross premium. So just to be clear, the gross premium is the final total premium you charge the policyholder. And it includes these different columns: the net premium, or your expected claims, the expenses, and the profit margin. So lots of items here. We're not talking about expenses and profit margin today. We're talking about the net premium column on the left. That includes your expected claims and your margin. So this expected claims is a simple formula. You need the incidence rate, or the likelihood of the insured event. So you need to find data to help you make an assumption on your incidence rates. Multiply that by expected amount of insurance claim. Now, you may need data here or not. If you're doing a simple product such as a term life where you're just paying a funeral benefit, for example, the expected claim amount is known. It's the amount of the policy. But if you have something complicated like health insurance or crop insurance, you can have small claims, you can have large claims, and you're going to need data on that expected amount as well. So the question is then, where do we get this data that we need? Preferred source would be industry data. Industry in this context means insurance data. You want insurance claims data, preferably insurance for similar products sold to the people that you want as your clients. And that's pretty challenging to find for inclusive insurance. So what you end up doing is using insurance products in other populations, maybe the similar product in inclusive insurance, but in another country, or you even use traditional product experience, and you have to make adjustments. So perfect data is ideal because you don't have to adjust it. The less ideal it is, the more adjustments you make. You also have public data. That would be online sources from the governments or nonprofits. You may be able to find something on the World Health Organization, for example, for accident rates for an entire country. Then you have to find some way to adjust that to your specific population. Distribution partners can certainly give you demographic information on their clients. So if you're going to sell through a microfinance institution, they should be able to tell you the gender breakdown and age breakdown of their clients. And the fourth source we want to talk about today would be focus groups and surveys. So this is great because you're talking to your potential clients and you're asking them things like, for health insurance, where do you go for healthcare? How much does it cost? If it's a funeral benefit, how much do funerals cost in your community? You're also asking things like, what's your capacity or your willingness to pay? One danger for surveys and focus groups is if you're not careful, you can bias your results based on how you ask the questions. So the example that I'm familiar with would be with willingness to pay. People may be uncomfortable, they're afraid to appear cheap. So if you were to ask in a group setting what their willingness to pay is, you may get a higher number than what they're truly willing to pay. Then you design a product with that target in mind and it won't sell because the premiums are too high. So if you're not familiar with market research and focus groups, it's good to find someone to help you who is. So we've got this challenge, right? This problem. It's difficult to find the ideal data. So what are some of the possible solutions? You can use incomplete data or data from a similar population and make adjustments. This is very typical. You don't want to make any more adjustments than you need to, but the downside here is sometimes you're forced to make subjective adjustments. It's not ideal because it's not going to result in pricing that best reflects the population. So another solution would be to conduct market research. And on our prior slide in the pie chart, this was the fourth item, the focus groups and the surveys. We have a couple examples of market research. On the left is a paper written by Lisa Morgan and John Meerchert from Milliman, and this took place in South Africa, where they prepared a health questionnaire and they priced a hypothetical health product. And this reading is really interesting. It has a few contents. It has the full list of questions that they ask, as well as the questionnaire results of the survey, and then they explained how they went through the pricing using those results. On the right is a book by David Dror from the Microinsurance Academy, and for over a decade, they set up health microinsurance programs without any pricing data for initial pricing. All their pricing was done on surveys, and then they ran it through a stochastic model. And I had the good fortune of being able to review their claims experience over that period, and it was kind of remarkable that their actual claims ratios were reasonably close to the target. So it's proof that using not having data does not prevent you from having a sustainable insurance product. So one difference between the left side of the screen and the right side of the screen is that the left side, the pricing that was done was deterministic. We're going to talk, this is our next topic. And the right side was stochastic. They use a Monte Carlo simulation. So just flashing back to our agenda, we've covered the first 3 points. As I told you, I warned you I was going to go fast through those. Now we are approaching the stochastic models. Then that will be followed by the Zoom survey, and then we will be doing a pricing demonstration using a Monte Carlo simulation spreadsheet. Deterministic pricing. Deterministic models, the assumptions are set as fixed estimates, such as the mean or a set of data, and the result is a single number. So we're going to do a quick example on this slide, but first let's read that again. Deterministic, the assumptions are set as fixed estimates, such as the mean of a set of data, and the result is a single number. So here we have a distribution of the frequency of claims, and on the right we have a distribution of the amount of claims. On the frequency, most people, these numbers are completely made up. This distribution, 60% of the people had no claims, 30% had 1 claim, all the way down to 3 claims for 4% of the population. The weighted average for our frequency is 0.54, meaning that you would expect the average person to have slightly more than 1/2 of a claim for the year, 0.54. For the amount of claim, for the people who did have a claim, half the population had a small claim of only $10, all the way up to a large claim of $150, 10%. That weighted average was $40. So then the way the deterministic pricing work is, you're going to work with these averages, you ignore the distribution. Our risk premium, the 2 averages multiplied together, get us a risk premium per person of $21.60. If we assume we're going to have 500 insureds, we multiply by that 500, and our expected claims for the cohort of people is 10,800. At the bottom line is a blank for margin. We want to add in some security, some margin there, because there is volatility in the claims. We may have higher claims, but this deterministic model doesn't really tell us how much margin to use. So for now, it's a question mark. Let's move on to the stochastic models. We're going to use the same set of data that we used on the prior slide. Stochastic processes have random variables. So variables, in this case, we have 2, frequency of a claim and the amount. And by random, we mean we're not going to just use the average. We're going to run a simulation, and sometimes the person will be have 0 claims, and sometimes they'll have 3 claims. And we're not going to just use the average claim amount for everyone either. We're going to use a range of amounts. That's why we call them random. You frequently hear the term Monte Carlo simulation. It is one of the ways to simulate a stochastic process like this. So let's say we have a stochastic model, and we are going to tell it we have an expected number of insureds of 500. We desire a confidence of 90%. What we're telling the model is, we want to be 90% sure that we're going to have enough money to pay all of our claims. And so it's going to calculate the margin we need for us. You're going to tell the simulation how many times to run. In this case, I'm saying 1,000. And it's going to run 1,000 times for 500 people. It's going to simulate claims 1,000 times, and it's going to generate a range of results for our cohort of people. And let's say then that average comes out to 10,800, like I did on the prior slide. Then it also tells us that the aggregate claims with 90% confidence is 11,232. So now we've answered that question mark, how much margin do we need? The final row is the risk premium per person. So we're taking the 11,232. That's the expected claims with the margin, so we're 90% sure we'll have enough money to pay our claims, divided by the number of people. So in the prior slide, we said the average claim per person was $21.60. So we've added 86 cents of margin here by using the Monte Carlo simulation. So here uses stochastic pricing. So people who are exposed to pricing for reinsurance and products that have a lot of variability by interest rates would have exposure to stochastic models, but I hope what you'll see when we do our example is this is still a powerful option as well for more simple products such as inclusive insurance. There are advantages and disadvantages to consider. Obviously, it gives a range of outcomes if you're using Monte Carlo simulation. You get some idea of the scope of how much your results may vary. It can tell you how much margin is needed. You can quickly scenario test with alternative plan design, such as changing your deductible amounts or your maximum payouts. And it can be done in Excel. There are disadvantages. First, it can give a false sense of confidence in results. So just because you say that you use stochastic pricing does not mean that you got the pricing right. You can misprice with deterministic models and you can misprice with stochastic models. Second, it may not simulate 100-year events. So for example, would stochastic pricing protect you from a pandemic like COVID? And the answer is probably not. And that's going to be something that Denis is going to tell us more about. So we're approaching what I hope will be the fun part of today's presentation. We're going to do a Zoom poll with 9 questions. And then I will, while Denis is presenting, I will take the results of the Zoom poll, input it into the spreadsheet, and then I'll come back to you at the end of the presentation and we'll run the Monte Carlo simulation together. So the questions, there's a preview of the questions you're going to see. In the last 12 months, how many days of inpatient hospitalization did you have? Did you or your spouse have a child? Oops, please, no poll yet. Asier. Oh, okay, on my screen I have the poll. There we go. Okay, so did you or your spouse have a child? How many x-rays or lab tests? How many outpatient treatments? How many visits to a doctor, either your general doctor or a specialist? How many prescriptions? And you're going to be given ranges for your answers. I'm not asking for exact memory of your cost. What was the total cost of prescriptions, either in dollars or euros? Please don't answer in 50,000 pesos. That would skew the results. How many emergency room visits? Okay, so let's see. This is a preview of the spreadsheet we're going to look at. I've already preloaded some product designs for a health product. I've input a deductible of $250, a prescription copay. After people pay their deductible, they have a coinsurance, meaning they're going to share 10% of the cost. There is no maximum benefit from the insurer. They have to pay an unlimited amount, but there is a maximum that the insured has to pay out of pocket if you combine their deductible and their coinsurance. Now, first thing you'll know is these are not numbers you would typically see with inclusive insurance. They're numbers I've input in just for our example today. At the bottom, I've also put in some cost assumptions. These may or may not be reasonable for hospitalization costs, childbirth, x-rays, outpatient, doctor visits, and how expensive an emergency room visit is. So this is a simplified illustration. I'll point out that I have hard-coded numbers here. If you had the data, you could make each one of these items another stochastic variable, another random variable. For example, if you knew how often emergency rooms cost, how often they cost $500 versus how often they cost $2,000, you wouldn't have to use a fixed number here. You could make that another complication in the model. We're going to tell the spreadsheet to calculate based on 500 insureds, a desired confidence of 90%. And if we have time, we'll run this multiple times. It can run 1,000 simulations in about 10 seconds. Running the simulation will give us it's going to calculate for 500 people 1,000 times what their aggregate costs are. So my label here is pooled net claims. Pooled means we're adding all 500 people together. Net means it's after you take out the deductible and other cost sharing items. So this is the actual cost of the insurance. And we'll get a range, 1,000 different numbers based on those simulations, low to high, of the aggregate cost. And then that will be used to calculate the median claim, the average claim, and the claim per person with margin. So you've not actually seen the spreadsheet yet. It's coming. at the end of the presentation, but if you want to download it after the session, it's available at the globalinsurancconsulting.com website. So now, ICII, if you wouldn't mind, if you could lead us through the poll. And Nigel, if you had any questions you would like to ask during this time, that'd be fine as well.
Great. Thanks, Jeff. That was really, really interesting stuff. And I think a few things strike me here. The first being that pricing is just not an exact science. There's a lot of uncertainty around it. So I'm just really keen in terms of how you manage that uncertainty, because I always feel the only certain thing about pricing is that the number you come up with will be wrong. The question is just how far wrong it's going to be. And you sort of alluded, I think, to one of the key mechanisms there in the control cycle. I'm just keen to hear your sort of views around managing that uncertainty of the pricing.
I need to think through that a little bit. Let's see. So let me stumble through this answer, Nigel. The managing the uncertainty in the pricing. I'm still thinking on that. Nigel, Denis, if you wanted to
Sure.
jump in.
Yeah, I mean, that's one of the reasons why insurance companies have capital in surplus, or if somebody self-insures, they should have some surplus on the side. There is, we know things are not going to work out exactly as we expect, so you do need some margin to cover those fluctuations. And sometimes you'll get a fluctuation down quite a bit, which will give you a chance to accumulate some surplus, and sometimes you'll have it very high. The biggest challenge all the time is it a fluctuation? Is it a trend? That's an extremely hard question that we're going to try to look at when we talk about even COVID, like what's happening there. We're seeing some fluctuations and we don't know if it's permanent or is there going to be a trend in a certain way.
Okay, great. Thanks. Maybe just a bit of clarity around the poll. I think if you can answer as realistically as possible, but don't be too hung up about being extremely accurate. This is really just illustrating how one can run a survey to produce the results that you can then use in a stochastic pricing model. Maybe just one further question while people complete the poll from Susan. We're talking mostly about claims. However, claims are quite often low in microinsurance. Do we have any data on expenses versus the assumptions? And I think in my experience, quite often expenses, because of the small premiums, do make up a big part of the gross premium. So do we have any experience on how expenses relate to the assumptions made?
I mean, they talk a lot about volume. Then that's a lot of that is to offset your startup costs and your fixed overhead. So, I mean, you could do a break-even analysis to determine like how many policies you need to sell to make up for your high startup costs. If you're lucky enough to have a grant to start a microinsurance program, then that would offset your startup costs and make it you need less scale before you reach profits. I think a lot of times distribution costs can be pretty high. There's a lot of different models being tried. You can use digital to help get scale faster, like through cell phones or utility companies. But there are also people who are offering microinsurance products using agents. I think that's the BIMA model. So you just, when possible, partner if you want to. So I guess one way to reach scale faster is to partner with an organization that's already got a footprint with the clients, like their utility companies. They may not know insurance, but if they have a relationship with another organization that they trust, then that helps you build the scale faster with this population. Denis, did you have anything you wanted to add to that?
Sure. I think it's good to have a budget. Like any startup, if you look at a startup of an insurance company as an example, a model, as Jeff says, you'd have some startup costs and then you'd amortize it over the life I guess, a reasonable time frame. So same with a microinsurance program. I've seen many microinsurance programs start. Some of them have had grants, some of them have not had grants. And they just look at who their target market is and try to reach scale very quickly. If you reach scale very quickly, then your expenses are spread out over a shorter period of time. If you don't reach scale very quickly, you have very high expenses at the first year, even probably more than the premium. You still have to price the net premium correctly, and you have to price the margin that you want for your expenses. I think the specific question that Susan was asked, is there any data? In the landscape studies in the previous versions, they did have some information of some expense ratios in different markets. So I see around the world, Latin America seems to be very high on expense ratios. They have very high commissions. And in some of the models like BIMA, potentially there's very high expenses. So for the amount of premium.
Okay, great, thank you. Jeff, do you think we've had enough time so that you can close the poll? Or?
Yeah, so if you guys, we're going to close the poll now. I think that's a good idea, Nigel. And I'm going to take a second to capture the poll results, and then we can turn it over to Denis.
Yeah, while Jeff's trying to multitask, Denis, I'm going to maybe aim the next question from Catherine to you, if you don't mind.
Sure.
So since women typically have routine medical interventions, doesn't that create prejudice against them in pricing? And similarly for chronic illnesses and diseases, some of which affect women disproportionately. So I guess that sort of comes down to what's very often a fairly interesting debate in insurance circles around what is fair discrimination and what is not. Do you have any views on that?
Yeah, as an actuary, it's really important to capture some of the gender differences. And there's other pricing parameters that make a difference in pricing too. The distribution network, how an organization manages, all of those have an impact. So you want to capture each of those variables. Maybe what Catherine is getting to is potentially pricing on an equal basis for everybody, which in microinsurance we tend to do because it's just a lot simpler to do that. If you cross-subsidize one sector versus another, though, in the long run, you might get some adverse selection. If it's a well-distributed program and everybody buys into it, then there's no problem. One example I heard in the United States where they had community rating, I heard this from an actuary many years ago. I think it was in the state of New Jersey. They had a community rating pool for individual insurance, and the premium ended up to like $50,000, $60,000 a year. And people were still buying it because only the people that had really high claims were buying it. And the price kept on going up. So eventually you get into an assessment spiral, as we say in the actuarial literature, and that creates a problem. So you have to be careful. But it is, most microinsurance programs work. You have to monitor those trends, and over time, as the population ages, things are going to get different too.
Yeah,
okay.
Thanks, Denis. Yeah, carry on.
Okay, so you can see my screen now, I assume?
Yes.
Okay, great. Okay, so I want to talk about pricing, and I'm coming from I'm going to start off actually talking about catastrophic events and the impacts on survivors, and why this is important to understand catastrophic events for when we're doing COVID. I'm going to show you some emerging data from what we're seeing in COVID-19, and then talk a little bit about in anything that we do in insurance, a most important aspect is the prevention side. So we'll get into that. So in a catastrophic situation, that you see globally that people that survive these catastrophic events, they really have actually, there's some mental health implications that happen, which have social and political consequences. So the mental health issue is not talked about too much. In the last session, Shilpi did talk about in the situation in World's Women Bank, I mean, women are under a lot of stress, as well as a lot of other people with the situation of COVID. So just understanding that issue is important. We also have to help people understand how they can reduce or have an impact to reduce the events that are happening, like climate change. Like, for example, this conference, even though it would have been interesting to be in Jamaica, is actually fantastic that we're having a conference this way and reducing CO2 emissions a lot. So what's happening with catastrophes and climate impact? We're seeing increased frequency of events, severity, and natural hazards that are happening. For example, right now in the Caribbean, the tropical storm season, they've tied the number of the maximum number of events they've had in one season. And hopefully there's no more, but if there's some more, that'll be a record-breaking year. We've had several Category 5 hurricanes in the last little while in the Caribbean. So those are happening. For pandemics, even this one, that COVID that's hitting us right now, has had such a global impact and has equalized everybody that everybody's getting hit on this. This is not a new event. There's been other events like Ebola in West Africa, and also in Congo. There's been Ebola that's been out there recently, and there's been SARS several years ago. And I mean, some people are talking about that the environmental destruction is also having an impact on this. But when these events happen, who gets hurt the most? And I think it's the low-income populations that get hurt the most. And later I'll show you an example both from Canada and from information from the research we're doing with World's Women Banking. The cost falls disproportionately on the poorer section of the population. So people, for example, in Latin America are more likely to live in flood-prone areas or in buildings that lack the latest anti-earthquake standards. They're also less likely to have an insurance policy to pay for rebuilding. So we really need access to insurance. This is why I think inclusive insurance is so important. And with the hurricane or the typhoon in the Philippines, Typhoon Haiyan, it was one event where a lot of people, over 100,000 people, actually had access to microinsurance. So that's great to have that. Not great to have the disaster, but at least to have the coverage to help people through the situation. So this is another document that was done by the Asian Development Bank showing that from 2000 to 2018, 84% of the 206 million people affected by a disaster globally on average each year. Nearly 38,000 disaster fatalities or deaths per year on average. And they also found that those who suffer the most are the poor and the marginalized and the isolated. So beyond the immediate loss of life and that happens in an event, what happens over time? A study in India showed that without social protection, disaster-hit families depleted their savings or borrowings at higher interest rates from informed sources, pushing them into indebtedness and poverty traps. Recent research reveals that disasters can affect victims for decades. So the event that we're having today with COVID is not just happening now. It's going to be impacting us into the future. So families that reduce household spending on food, medicine, and education, they can stunt a child's potential well into adulthood. That is a real disaster affecting the whole livelihood of that individual for the future. More information on different parts of the research that 90% who have suffered in the past decade, the loss of life or significant damage of assets to floods in rural areas. The financial recovery took more than 3 years longer than in the urban households. So people in the rural areas are even at greater risk. So we keep on going down levels, some people are really hard hit, some people are less hard hit. The Pacific Island economies are especially vulnerable to severe hazards reflecting their isolation, limited economic diversification, and extreme exposure. So economists and development experts and world leaders have long warned that climate change is likely to hurt poor countries more than rich countries. And I think we're going to see the same thing with COVID. I want to use an example of, in the Caribbean, Hurricane Maria in September 2017 was a Category 5 hurricane. This is the same hurricane that people in the United States heard about in Puerto Rico, which actually was only a Category 3 when it hit there. In Category 5, the wind speeds are 160 miles per hour, and there was 65,000 people, that's probably 80% of the population, were directly affected. More than 90% of the roofs were damaged or destroyed. 31 people died, 37 missing. Power and water supplies disrupted, and the entire crops are destroyed. So this is the estimated damage in that country. So it was 224% of the GDP of that economy. There was some insurance provided by CRIF, which was only 20 million US dollars. In a study I've done on the mortality of that country following that event, mortality has increased by 20% the year following. So this is showing, this is on a credit life portfolio that is in that country. And the credit life portfolio is usually relatively stable over time. And a 20% increase is very high. This is going to, we did a study also a couple of years following, and it's gone down a bit, but it's still much higher than it was before. So this is the thing that we should be looking for in pricing, is these historic shifts in mortality. So how do you price now when we're looking at COVID? I guess I've always worked in pricing without data. I've been doing that for the last 20 years. So some of the things that Jeff was talking about were really good. And David Drawers, in his survey, what I really liked of what he does, he gives also, when they're doing surveys, they also give an idea of the relative price for an event. And when people do surveys, household surveys, only asking willingness to pay without putting the information of what the expected cost would be, I think it gives you a false answer. But there's been recent information by Swiss Re that has been published. In the previous session, we heard from World Women Bank. They're pricing some information, and I have borrowed 2 slides from Gilles already on that. The most important thing is to understand the context of the market. So I'm going to show you what has happened in Canada, and it's going to be a totally different context than what you see happen in another country. So you have to really understand, if you're pricing, where you are, what the context is. And the area that I really want to focus or have people think about is look at the future long-term impact. I am concerned about the distribution systems. Are they going to survive? If sales volumes decline, the question we had from Susan, like, will expenses increase? So will that cause a problem? Will safety protocols require more expensive procedures? These are all things that we'll have to look at. Right now, today, we don't have the answers, but are things that we should start thinking about. And I also wonder, will efforts to reduce risk provide a bigger payback? So countries like Taiwan have handled COVID very well compared to the rest of us. And people sometimes say some of the measures they took might have been extreme, but they actually got it under control. And then if you're involved in pricing, Jeff was talking about stochastic and deterministic models and providing some estimate for a margin. It's also, at some point in time, you have to take an intuitive guess. If you overestimate, then the product won't succeed at all. It'll be too high price and it'll never sell. So what is the Swiss Re research showing? I think it has an idea, it gives us an idea what would happen on COVID-19. they highlight mental health issues will develop. The financial stress on low-income populations is extremely high. People that are starving, if their kids are not getting enough nutrition, that'll impact well into the future. The anxiety of infection, some people are very scared to even move around and what this will impact on them. So that's going to have some impact also. In this Swiss Re study, they mentioned from the Ebola, they have studied the Ebola impact 18 months afterwards. And at 18 months afterwards, 48% of the population had one indicator of clinical depression, and 6% had clinical depression, still 18 months after the event. In COVID, there's some indication that there might be some possible long-term organ damage, and hospital readmissions increase for those with COVID. So that's a concern. So this is from the World's Women Bank study. So if you're in the previous session, you saw Gilles present this. This shows the monthly hospitalizations. So you have the gray and the orange are the years 2018, 2019. And then in 2020, you could see the change in hospitalization. So just with COVID, because of the shutdown, people had less access to hospitals. Some people are probably not going because they're fearful of even going to a place where there might be COVID. In this study, it should be, we actually have the data up until the end of September, so most of the claims should be reported by now. There'd be very little that are unreported, so it still should be pretty accurate. But it does show that there was an impact of COVID. If you're pricing a health product like this, does this mean that these rates are going to be low going forward? Or is this just a fluctuation because of this major event? And will it mean that the pricing will increase going forward in the future because of the stress and the anxiety that people are having, which will have a detrimental impact on their health? The more concerning one was this was from Egypt, the use of maternity and gynecology in the hospitals declined rapidly during the COVID period. So that may have an impact on the maternal health of mothers. That's not a really good sign. This is a recently introduced study by the Canadian Institute of Actuaries. So this is, I was also on this committee when we were looking at designing this study. What we did is looked at the count of people that were insured under group insurance policies and individual insurance policies in Canada. And in Canada, the group insurance policies are mostly for people that are under age 65. So you see in this thing, there's about 8 million in group insurance and about 10 million in individual insurance. And then we looked at the number of claims by month for each of those programs. And you could, interestingly, you could see in the group insurance area that the number of claims actually went down in Canada. In Canada, there was a lot of income support for everybody that lost jobs. So there shouldn't have been anxiety over a financial situation. In fact, savings rates have actually gone up during the period of COVID. And because there was less traveling to and fro, there was actually a total drop in the number of deaths when we look at total deaths. So it could be for several reasons. We can speculate on what they are. Like I speculate there's less accidents, less air pollution for people that have asthmatic issues. So there's less claims generally than in the prior period at the same time. And if you look at the claims amount, it was also the same. And then if you look specifically at the COVID deaths, those are quoted as COVID deaths. In group insurance, there were some, but not very much. But that increase in COVID claims was offset by a decrease in other mortality. So that has a big impact on group insurance. In individual insurance, is probably an average age group much higher than the group insurance, and probably people over age 65, which were most impacted in Canada. So I think with COVID, the whole world has changed. Everything has changed. So all of us are still learning. Fortunately, now there's some emerging data coming out that's helping us start understand this. And as in the Swiss Re study pointed out, SARS and Ebola did point to emerging issues that'll come. Distribution systems going forward are going to be impacted. Hopefully there's a move to more IT platforms that will reduce costs and make it easier access. But we also have to remember who we're trying to reach with inclusive insurance. And as an actuary, when I start seeing these studies, that helps me to form an opinion going forward on how I can adjust my pricing. So I think in conclusion that inclusive insurance is important. Regulators have an important role to help make it easier to expand markets so that people can actually have coverage. Insurers have to also do that, and as well as distribution channels. Risk mitigation is critical, and that's the item I talked least about, but that's an area that really needs a lot of work in helping people reduce their risk to different events. And if you're an actuary like me, I love monitoring results. That already starts telling me information. So for example, with the World's Women Bank study, already we're seeing some results, and it helps us start formulating questions of how things will go forward. When you're pricing, you do need a holistic view of the situation and the future trends. So you can't take the Canadian data and apply that to Egypt because they're totally different contexts. So you have to really make sure the context is correct. So that's it. I'll pass it back to Nigel.
Thanks, Denis. Yeah, that was really, really interesting. I think one of the key things that struck me there was that when we think of particularly your natural disasters, we always think of the immediate impact of those disasters. I think COVID, you know, we've seen the lasting impacts of it, but well, those impacts are still going to be running a long, long time. So clearly from a pricing and just operational perspective, one needs to think of the immediate impacts and those longer term impacts as well. That's really important. That sort of interesting thing to me is, again, you sort of mentioned the monitoring, which speaks very much to the control cycle, which is a real fundamental part of I guess, managing uncertainty. Because like I said, the one thing that is certain is the numbers we come up with will be wrong. The question is just how far wrong. But how much does that help for sort of really unexpected events, like well, natural disasters in some areas, but COVID? A year ago, no one was sitting there expecting COVID to have had this impact in the world.
Yeah.
Yeah.
Well, first of all, I found it interesting. When I looked at Hurricane Maria, I started searching in the actuarial literature. That's where I found those ADB studies and things like that. But I didn't find anything in the actuarial literature talking about the after event, what the impact is. And I saw it very starkly in the island of Dominica. There was very strong impact. So you going forward, yes. Sorry, I forgot the second part of your question there.
No, it was just around sort of using that control cycle, monitoring.
Right.
So how effective is that at these sort of shock events, which are quite often very unpredictable?
Yeah, the control cycle is important to monitor all the time, and actually monitoring it too frequently, like every month, you wouldn't be able to pick up trends. So you have to find the right frequency. So for different products, there's different frequencies to look at the controls at things. So for example, in Canada, for pricing group insurance, group life insurance, I would say companies only have to look at that every 5 years. But for disability insurance, they should be looking at it every 3 years. Over time, I've seen shifts in the expected claims by different age groups. So there's something underlying happening in the population all the time in every population, so that you have to decide when you're going to price in these shifts. If you're spot, like for what we're seeing with COVID, what I suspect we'll see with is a mental stress is going to have a big impact either on hospitalization or mortality going forward. So that one you have to start watching. It's never for mortality. It's, well, in the Caribbean, in Dominica, the 20% jump on a credit life portfolio is the biggest I've ever seen jump from one year to the next. But for a credit, for general mortality, it doesn't usually shift that quickly. Maybe we will see something going forward, like people that are stressed out by the situation and are in difficult situations may end up with higher mortality. So it's something to be seen.
Great, thanks, Denis. That your answer actually reminds me of something you told me quite a few years ago. I think when I was just getting into microinsurance, and that's monitor and then be inquisitive. Ask the questions. Ask the right questions. Use your monitoring to start asking the right questions. So without that monitoring in place, you don't know what questions to ask.
Right.
Jeff, can I maybe check with you? Are you ready to present your results of the Monte Carlo run that you've done?
Yeah, I'm ready. And I apologize to Denis. I forgot to turn off my mic when I was clicking around and turn off my camera. Hopefully I wasn't too distracting. I was.
No, I didn't hear you.
Sure. So I can share my screen then, and we'll take a look at the spreadsheet.
Can I maybe just ask participants to continue sending in their questions through the Q&A, and once Jeff's finished presenting the results, then we'll get back to the Q&A.
All right, thank you again. So the spreadsheet is, I'll walk quickly through the tabs and then we'll run the simulation together. The first tab is a disclaimer saying, if you download it and use it, don't sue me, please. The second is an instructions on what is in each tab, where are the parameters that you can input, and which tabs have the output from the programming that's behind the spreadsheet. This control tab should look familiar from the slides where we put in the number of people in the program, desired confidence, and the number of simulations. So there's nothing magical about 90%. The higher the confidence you want, the more margin it's going to put in your premium. And there's nothing magical about 500 insureds. The fewer people you put in, the more volatility you're going to have in your results. And again, you're going to get higher margin. So if we have time, we'll run it twice, once with 90% and 500 and once without. We'll click the run simulation and some things will happen. Let's go ahead. We'll come back and look at the results in a moment. The next tab is design and assumptions. This was from the slide where I showed you the deductibles and copays and the cost assumptions. I've got the maximum benefit disabled, and there is still a $1,000 maximum out of pocket. The responses tab is where you input the results, in this case from our survey. So I put in 100 responses because the results were in percent. So 79% of the people I think had no hospitalization days. So I put in 0 for the first 79 rows. There is a age bracket and gender. It's not used in the calculations at the moment. So I've just set everything to a male age bracket 2. So all of your results are anonymous. I think that this sort of information, the demographics, could be useful for someone if they wanted to analyze the survey results by different demographics, but it doesn't at this point affect any of the calculations. The blue tabs are created from the programming behind the spreadsheet, so the macros. So the response results, first it just sorts the survey results, and then that is used as our distribution for the random variables. You answered 9 questions. We have 9 random variables, and then these are the sorted values. Monte Carlo results. This would be, there should be 500 rows here. I hope there are, for our 500 people in the program. So this would be the Monte Carlo results for one simulation. We're gonna have 500 rows here for 500 people. It calculates the random results for all of the different parts of the program, like prescriptions and prescription costs. It gives us a gross claim takes out the cost sharing of copays and deductibles and coinsurance, and gets a net claim amount. This is the cost paid by the insurance company. The spreadsheet would sum this net claims number. So for the whole 500 people, we have a value of 2.5 million. That's our claims for the year for the whole program, and that gets saved in the final tab, pooled net claims, and then it repeats it again 1,000 times. It's doing this calculation for 500 people. This pooled net claims in is referenced back. Let's go back to the control, the results. It's looking at these pooled net claims to calculate what the average claim is per person, the median claim, and the claim cost with margin. So it's just taking the total amount of claim and dividing it by our 500 people. So I've actually ran this to make sure it worked. These are the results, but I can do it again. It takes 10 to 15 seconds. So let's just look at the results before I run it again. We're saying that the average claim based on our survey was $49,000 per person. And then we need to add in about $440 of margin if we want to be 90% sure that we'll have enough money to pay claims. As I said, if we want to lower the number of insureds, say that we're only going to have 300 people, that's going to make our margin higher. I need to rerun this. And if we want to put in 95% confidence, that will also increase our numbers, our margin above the average. So we can run the simulation here. Let's fingers crossed this only takes 10 to 15 seconds. So our margin before was about $400 between the average and the confidence number. We should see something higher than 440 this time. Yeah, so our average is 4,900, and I don't remember what it was before. It's 4,800 something, so it didn't move much, but the jump in the margin is pretty significant, and it's now $800 to get to the 95% confidence. And the fact that we have fewer insureds means we have more volatility in our results, so that's going to increase our margin as well. That, I think, is all I have. If you want the spreadsheet, you can, like I said, you can change anything on the gray tabs. It will let you change the deductibles and the expected costs, and you can rerun it. Nigel?
Yeah, thanks, Jeff. Yeah, a really nice illustration of how the tool can be used, and how, I guess, Monte Carlo simulations and a stochastic model to price works as well. So with my limited understanding of statistics, you obviously need a distribution for, in this case, the claim amounts that you are running, and that distribution you get from your survey. So so without a survey, you pretty much, or without having that distribution, you cannot obviously do stochastic, and you're then sitting back with the normal deterministic way of doing things.
Right. I would say that you're better off maybe using deterministic if you don't have data, if you don't have the distribution data, like you said, if you don't have survey results, or even if you have a simple product like a term life or a funeral benefit where the claim amount's a fixed amount. I don't know that you're going to get much benefit by going to the trouble of making a stochastic model. I think this is more useful for, like you said, when you have the distribution and it's a product where the claim amount has some variability in it.
Yeah.
And there, I mean, one of the downsides of this I didn't mention is there is some development time, in creating the model. You can obviously run it quickly and make a lot of changes very quickly. It's very efficient once you build it, but the deterministic model, you can build much faster than the stochastic model.
Maybe just the issue of the tail risk. I think, Nigel, you asked that before and I didn't answer that. Like a pandemic is a very rare event of this scale. It's a 1 in 100 years, just like category 5 hurricane should be a 1 in 200 year event or something. So there's easy to get in reinsurance for something like a natural disaster, for really tail risk. But for a pandemic, I think it's much harder to get reinsurance. And that's how you should have something in your pricing for a tail risk. And maybe that's taken care of by the capital and surplus of the company. Maybe when people do modelings for insurance company, they consider that. But that's an event that you have to consider is the tail risk. And
Yeah.
the tail, and yeah, so anyways.
Okay, great. Thanks. Maybe let's just go to the Q&A. I see there are a few questions coming in around low claims ratios. So let me say, this morning we learned from the 2020 landscape study, low claims ratio is a concern for most inclusive insurance. And yeah, my experience that's quite frequently seen, although I have seen claims ratios that are extremely, extremely high. But is this potentially also the low claims ratios reflective of inaccurate assumptions and pricing for some of these inclusive insurance products? So yeah, is it a result of actuaries and other people who are pricing being overly conservative, or are there other factors influencing it?
May I can just a low claims ratio, like the mobile insurance platform has a low claims ratio, probably because people don't really understand they have the coverage. So if I pass away and I had insurance on my mobile phone, does my family know to look at my mobile phone for insurance? Probably not. So there's a generally accepted mortality rate, for example, in each country. By looking at the WHO tables, you can see where it is and understand the distribution of the population. You could figure out where the mortality rate should be. And if it's much lower than that, there's probably some misinformation people don't know. If it's near that and it still have a low claims ratio, then at that point, I think you can start looking at adding benefits. So there was a program we saw in Nigeria, a credit life portfolio that had a low claims ratio. It was actually at the right mortality level based on that population. They started adding benefits. They started adding a benefit for maternity for their members. So that's how they started increasing the claims ratio to the price that they were charging. So there's different ways of doing it. But first of all, it's important to understand where you are versus where things should be. And is there another problem?
Yeah, I would just add that it was mispricing. If it was intentional, maybe not. Maybe it was intentionally conservative, or it was you have really high distribution costs, so that's driving down. But then it's also possible that you didn't have good data to price with, and they made a mistake. That's about all I had. That's all I have to add to what Denis said.
And I've seen actuaries in the past that are new to this area that don't know it, and because they're conservative and they're nervous about it, they just add margin after margin that it becomes very high price. So their lack of confidence is a problem.
Yeah, something as actuaries to be very, very aware of, that lack of confidence, and making sure that you don't add margins on top of margins, because that quite often happens. You add margins at each and every step, and you don't look at what the total margin is. So yeah, also interestingly, I've seen very, very widely differing experience on a hospital cash product, where in one instance, and it's an identical product sold to very similar customer bases, the claims ratio is very close to zero, and in another instance it was in the hundreds. And that's just very much down to customer awareness and also very low volumes, where the customers who were actually buying the product were anti-selecting on the one hand, and then very low awareness on the other hand. So it does become very difficult to price accurately when your volumes are very low as well. So another question on similar vein, I think, Denis, you've answered it partly at least. Is there anything that can be done from a pricing perspective or product benefit design that can address this low issue of claims ratios?
Well, I think it's a philosophy of the organization selling it, frankly. What are they trying to do with their customer base? Are they trying to look for the long term and provide value and increase market share that way? Or are they trying to get a short-term profit on this? Yeah, it's a difficult question to answer, sorry.
Yeah, in my mind, it probably also again comes very much down to what you've been saying, Denis, of monitoring, and then asking the right questions when you start seeing the experience diverging from what you priced on. If it's too low, try and understand why it's too low and take corrective action. But again, as you say, that does come down to the philosophy of the insurer, whether they are in for the quick buck or whether they're looking for probably what needs to be long-term sustainability, where they're making a reasonable profit.
We saw it in the last session. The regulator from Pakistan was saying that they force the motor insurance companies to provide a rebate to clients because there was less accidents. In Canada, the insurance industry did that automatically without being forced by regulators. So, and in different products in Canada, for example, on the extended health benefits, people couldn't go see chiropractors and things like that. Some insurance companies reduced their rates by, one insurance company reduced their rates by 75% for that period, and other companies reduced it by 20%. So very different philosophies of how you deal with something.
Yeah, this may be something Denis already answered in his presentation since I missed most of it. The low claims ratios is a real danger. I mean, if you don't have people having claims, they're not going to renew their policies. And you're also going to not build any trust with people. They're going to continue to not trust insurance. You need to pay some claims for people to learn to trust insurance and to renew their policies.
Yeah.
So maybe it's time to start doing some awareness campaigns and insurance education if the claims ratios stay low.
Yeah, Jeff, and another one for you, a bit more technical. Does a stochastic simulation always use a normal distribution, or can it be adapted to assess fat tails?
Oh boy. I think you can. Well, so that the data we put in was not a normal distribution, right? So I'm either. I mean, there's a distribution on the front end in your inputs, and that's usually not. It's going to be a skewed distribution where a lot of people have small claims. It's going to be skewed towards zero. But then I think that what you're saying that you can build a distribution of your claim amounts with a fat tail. It can be small. All the inputs, I think you can put whatever distribution you want in there. And then hopefully, though, what you see when you run the distribution and you get like a pool of 500 people, it should be concentrated in what looks more like a normal distribution where there's a concentration around an average and then tails on both sides. So I think that you'll get kind of a normal looking distribution in your output for an aggregate group of people, but your inputs don't have to be that way. And I am not a statistics expert. So if there's a university professor in here, they're probably rolling over in disgust at what I just said.
Great. Denis, I think the next question's more at your side and from Stephen. So he's interested in the suggestions you're making around risk mitigation. Do you have any thoughts, suggestions on what insurance companies could do on the life and health side to actively mitigate the risk from COVID-19? And is there an opportunity for working as a consortium or industry? That is, would it make sense to have some kind of joint public education initiative or work with local health agencies to improve public health initiatives?
Yeah, that's difficult to answer. I think fundamentally it starts with the governments and their stance on it. And unfortunately, this issue has been made political by some different people in different situations. So I think something like this, because it's such a widespread event, does need industry collaboration. So it'd be great for the insurance industry to talk to government officials saying, here's how things can be done. As I said, countries like Taiwan have done a fantastic job. Where I live, my city, we're down to 0 cases now. It's a city of 200,000. We're now 120 cases. Like it just shot up all of a sudden. It's because people were reluctant to wear masks and reluctant to believe that there was a problem. And I'm not sure even education helps in a situation like this when people think it's a conspiracy theory, that there's nothing that's really happening. So it's a really difficult situation that we're in right now when we have a lot of people that are saying there's no problem. But the insurance companies, I mean, thinking of what, a product like Discovery Health did in South Africa, where they incent people to do the right things. You know, following along that line, if you could price a product, if people are doing the right things, to give them some incentive to do what is best for them and for everybody, that might work.
Okay, yeah, thanks, Denis. So yeah, I guess Stephen's question also touches on the issue of risk mitigation as sort of before the event, effectively, which in my mind is actually a win-win for pretty much all parties involved, because it reduces the overall cost, which means that in theory insurers can actually charge less. So again, if you're incentivizing, as Discovery Vitality does, incentivizing better health, that means the lower health claims and they can charge a lower premium and they become more competitive in the market,
Right.
which
Yeah.
sounds like a win-win-win for everyone, in my mind. Okay, so another question, given the current uncertainties now and future around COVID-19, what would you suggest? Should insurers revisit their pricing?
I think they should start monitoring what's happening, and it depends on the product line that they have. So, for example, like the example I use of motor insurance, if there was a reduced driving, there would be reduced accidents. There would be a temporary decline. In health insurance, like what we saw in the data from World's Women Bank, where the hospitalization rate dropped for a while, I think they have to wait a little longer before they react to that, because I suspect it might come back up as this event carries on, or even if it goes away. There might be a change in behavior. We're in a totally new world right now, so monitoring is really important, looking what's going on. And before I said don't monitor too often, but in this case you have to be looking at what's going on. You have to be searching for other studies like the Canadian Institute of Actuaries just released, or World's Women Bank. They're going to be doing a longer term study, so hopefully there's more data from that. And or others like Swiss Re, they put out a study saying what potentially happened. So for some of the clients I have, in some cases they have lowered prices temporarily. For some lines of business, it actually reduces costs. And for other lines of business, it has a potential to increase costs going forward. So in Canada, for example, on disability insurance, we think we're going to see more stress type claims, and we think it will increase costs. So we're making some initial guess right now at what that cost will be, but the companies are slowly looking at changing some of their rates for these events.
Okay. Thanks, Denis. Yeah, another interesting question: how long should it take a company to handle and settle claims? I guess this is again speaking very much to the customer value side of things. Do you have any views on that? Not particularly pricing, but a very relevant issue around customer value.
Yeah, it was in our key performance indicators when we published that many years ago. You should be as fast as a money lender. If you're more than several weeks to pay a claim, you're creating a problem for that family. So you have to be fast. And when I first got involved in microinsurance in the year 2000 with Vimo Sewa, it was taking 3 months to 6 months to get the claim paid. And that was because the insurance company's processes were very slow and everything. But they changed that very dramatically to getting it paid, within the day. So I'm a strong believer that claims should be paid rapidly and also verified in that, so that you stop the fraudulent claims, because there's always going to be fraudulent claims. In the pricing thing, one thing we didn't cover is the whole context. Like, different organizations have different results based on their ability to monitor and eliminate some fraudulent events. So especially for health insurance, you could see quite large variations in pricing. So I always use the example, there's 2 products I saw in India that were exactly the same in wording, but one had a claims ratio 10 times the other one. And that, because the one that had a very low claims ratio, no, actually the claims rate was 10 times the other one. The one that was very low was managing everything well. People were getting value, they were getting their coverage placed. The other one wasn't managing anything well. They're getting fraud from the providers, fraud from their clients. So the whole context is even more important than, like, I don't know, Jeff, in your stochastic models, if you could consider something like that. The whole management side, I think, is far more important factor in the actuarial pricing of these products.
Yeah, so that's a really interesting point that you make, Denis, that I guess your high claims ratios are not necessarily a good indication of value, because it can be an indicator that something major is wrong with the system. And obviously if it's too high, it's just not sustainable in the long run either. So another question, I guess, coming back again to the low claims ratios and value for customers, is that value-added services are an optional strategy for making insurance appealing to the low-income market segments. Is there scope for addressing this, particularly for products that may include preventative and post-pandemic measures aimed at reducing the impact of the pandemic? And then how does this look from a pricing perspective? I guess that's sort of, again, heading towards the incentivization of good behavior that we've spoken about. Any thoughts on that?
Yeah, not sure. Maybe repeat that question again, sorry.
So value-added services is an optional strategy for making insurance appealing, which may include preventative and post-pandemic measures aimed at reducing the impact. So I think, again, potentially incentivizing the right behaviors. How does this look from a pricing perspective? I guess one of the key issues coming out here would be that you essentially introducing uncertainty around the extent to which you are going to change behavior. And that's what you need to try and allow for pricing in the pricing side of things, if you do take it into account in pricing.
Yeah, I've seen presentations by Discovery Health where they have measured sort of the behavioral change based on so what they were doing was very logical. So you can measure the impact of what you're doing. And
yeah, I'm sorry, I was going to say you will end up seeing it directly in the claim. So if you are monitoring, you can take your action accordingly. So if you're starting in a very uncertain environment, one of my suggestions would be to run it in a sort of fairly contained pilot environment and see what the reaction is. And then that gives you real hard pricing data to scale on, so that you've got certainty when you scale.
Yep.
So would an example be like if someone signs up for your health product, you give their family masks to wear? That would be the kind of good behavior you're trying to give?
Yeah, I've seen that for primary health care. For example, there was one mutual health insurance organization in Rwanda that provided mosquito bed nets to families when they signed up, and that lowered their costs actually, and you could see in their claims rate it ended up lowering how much they're paying out. So yeah, there can be some really direct effects, but the question is, is somebody going to use it or not? How do you monitor that?
Jeff, another one for you on the Monte Carlo side of things. Have you seen any other example simulation methods for stochastic pricing models other than Monte Carlo?
I have not. I think that like I've never worked in most of my pricing has been deterministic. I've done other than seeing what's done in the Microinsurance Academy, that's the most concrete example I have. But I think that there are people who do pricing for reinsurance companies and people who do products, like I said, like variable annuities and universal life that have a lot of interest rate risk. they would have a lot of exposure to different types of simulations that I don't have.
Okay, thanks. Another question from Joyce. I've been impressed with the pricing parameters, especially the part where considering impact of the distribution model on the premium ranges. Are there distributors currently demanding insurers to go down the route of pricing their own product as opposed to what insurers are providing? So I guess this speaks very much to the balance of power in distribution relationships in a lot of inclusive insurance models. Any experiences from either of you?
Well, just that there's a big difference, mainly around, yes, one of them is if the distributor is asking for a lot of money for their work, more than what is reasonably justifiable, that's a problem. But some of it is just the models, some of them are just better managed and do a better job of reaching people, communicating with them, and they end up with lower costs. So they must have a cost structure within their organization. As long as they're compensated for that, then that probably has an impact. But some organizations are just terribly managed on every aspect, and they have models that will fail at some point in time.
Mm-hmm. Okay, maybe a final question before just to ask for each of you to give closing remarks. So the question is around the cost of microinsurance is pretty high, given, especially in developing nations, one needs to reach a critical mass on one hand, which is costly to do. So I guess that's speaking to the distribution side, which is often costly. And on the other hand, premiums are small ticket amounts. How does one make these small premiums profitable?
Well, the key is always the distribution network. Nothing can happen without a good distribution network. So, and maybe with technology, it'll be a better way going forward. I think that's what we see with BIMA and Microinsure trying to do, and I think they're very innovative in at least reaching in a new way of reaching people. Even if I had some critiques of them, I think it's a promising future. But if you don't have any distribution system, it's not really it's not going to work.
Yeah, the one, I do think it helps to have distribution to get scale. The one kind of different solution I've seen work would be the Microinsurance Academy, where they kind of do like a group policy where the group polices itself, like in terms of fraud and making sure each other are paying their premiums, not through peer pressure, not through negative peer pressure, but your neighbors know that you're frauding or you're not paying your premiums, and then that helps control the claim costs. And then also they have an interesting model for distribution. They're not out to enroll a ton of people, but they keep the cost down, and they want everyone in the group to enroll. And the way you get everyone in the group to enroll would be to have them design their own products. So they had some interesting models in terms of educating the group, these rural villages, about insurance and helping them pick their own policy parameters about what benefits matter the most to them, to kind of drive up closer to 100% participation. Really, like what Denis said, usually you hear about the need to reach scale and large programs to offset the cost. But the one example that I have that wasn't really a factor was the way that they were doing it with rural villages, where you got 100% participation.
Yeah, I've seen the same thing in Bangladesh, in rural villages, where they get a really high participation, and it works very well.
Okay, fantastic. Thank you very much. Yeah, Denis, Jeff, would you maybe each of you like to give just a very brief one-point takeaway that you would like the participants to take away with them? Sorry, I am putting you on a bit on the spot because I didn't ask you to do that. Apologies.
Denis, you can go first.
Okay, well, the world has changed. So COVID is really a once in a life, or not even a once in a lifetime event. And that has really changed absolutely everything in the world. I hope for the positive, and I hope we can monitor how it goes and help move it into a good direction instead of a bad direction.
And I guess my takeaway would be that just pricing is challenging. It's particularly challenging finding the good data to use in this market, but there are solutions. So be creative, and I've highlighted a few different options for different sources of data, and stochastic is just one option, and surveys are one option, but it's something that's interesting if you can't find the data that you're used to doing traditional markets.
Okay, great. Thank you very much. And if I may just add one insight that I've gained again, is that, yeah, monitor against your experience and then ask the questions. And yeah, and adapt quickly. Be prepared to adapt quickly. Make sure you got the data and monitor. Yeah, just before everyone leaves, I'm going to hand over to Dirk. But before I do hand over to Dirk, I just want to say thank you to everyone for attending, and thank you for the excellent questions. And thank you to our two panelists as well. I really appreciate the time that you've put in to prepare for this, and I think it was a really good session. So thank you very much. Over to you, Dirk.
Well, thank you, Nigel. Thank you, Denis. Thank you, Jeff. Usually in the real conference in person, everyone would have a nice round of applause now. So you'll get that virtually. Thank you very much for that interesting session. I just wanted to invite everyone for tomorrow's session. So we start at 9 in the morning. It is Berlin, Munich, Paris time, and I'm looking forward to a very interesting session. There were several questions about presentations and is there a recording available? Once we get the recordings of the sessions, we'll put them on the conference website as well as the presentations. So we'll try to make everything available as much as possible. So thank you very much for attending, and I hope to see most of you tomorrow here again. Thanks. Bye-bye.